A lot of buyers are surprised when their friend gets an appraisal waiver and they don't. It feels random, but it's not. Fannie Mae follows very specific rules, and once you understand them, the whole system starts to make sense. So in this video, we're going to break down exactly when a property can qualify for a Fannie Mae appraisal waiver, which they now call value acceptance, and what you can do on the buyer side to understand your chances before you make an offer. So if you're trying to close faster, reduce out-of-pocket costs, or avoid the stress of an appraisal report, this will help you see what's possible and what isn't. So let's walk through it step by step. Before we get into the rules, let's get the foundation clear. A Fannie Mae appraisal waiver is Fannie Mae telling your lender, you do not need a new appraisal for this property. We already accept the value that you provided. That's what value acceptance means. When this happens, the lender is allowed to skip the full appraisal, which removes the appraisal fee, cuts days off of your closing timeline, and eliminates the risk of an appraisal coming in low, and it just simplifies the entire file. Buyers love it, agents love it, lenders love it, but it's not something anyone can request, force, or manually override. The decision comes directly from DU, which is Fannie Mae's automated underwriting system, and it looks at dozens of factors behind the scenes. And here's the biggest misconception. You cannot ask for a waiver. You either meet the criteria or you don't. So the best use of this video is to help you understand what those criteria are, what limits your chances, and where buyers get tripped up without even realizing it. There's one rule that sits above everything else. A prior acceptable appraisal must exist in Fannie Mae's collateral underwriting database. So this is the part that most buyers have never been told. Fannie Mae can only offer value acceptance if they have a prior appraisal for the property, the prior appraisal meets quality standards, and the prior appraisal is usable under CU scoring. So if the property has never been appraised by a lender that delivered a loan to Fannie Mae, there is no prior report for Fannie Mae to use. No prior report means no waiver. That means that brand new listings, long-held family homes, homes owned free and clear, homes refinanced with the lender who sold the loan to another entity, new construction with no prior as-is appraisals, and properties that just haven't changed hands in the last 10 plus years are all less likely to qualify. This is why two identical homes on the same street can produce different results. One has an eligible prior appraisal in the CU database, and the other one does not. It's not personal. It's not about the buyer. It's not about the strength of the file. It's simply data availability. If the prior appraisal is in the system and meets quality standards, Fannie Mae can evaluate the file for a waiver. And if it's not, the system will stop it right there. Even if there is a prior appraisal, Fannie Mae will reject it if the appraisal had a CU overvaluation flag, if the appraisal could not be scored, if the report had quality issues, if the report doesn't match the address correctly, if the data in the CU doesn't align with acceptable thresholds. So in those cases, DU cannot rely on the prior appraisal to support the value, so it will not issue a value acceptance. Again, this has nothing to do with your loan strength. It has nothing to do with you as a buyer. It's strictly a data quality rule. That's why this process feels random from the outside. It's not random, it's invisible. Now let's shift into the actual eligibility criteria, the part that buyers care most about. So value acceptance is only available for one-unit properties. This includes single-family homes and condos, principal residences and second homes for most purchases and refinance scenarios, investment property refinances, so not purchases, refinances only, certain purchase transactions as long as the loan-to-value is within Fannie Mae's limits, certain limited cash-out refinances, certain cash-out refinances, loan case files that received an approved eligible finding in DU. So if the property and loan fit inside these categories, and there is an acceptable prior appraisal, DU may offer value acceptance. But there are limits inside the limits. So let's break those down because this is where buyers start to understand their actual odds. For purchase transactions, Fannie Mae allows value acceptance when the property is a one-unit home or condo, it's a principal residence or second home, and the LTV or CLTV is 80% or below. That last part is important. So if you're putting less than 20% down, your chances drop significantly, not because of risk, but because the waiver rules simply don't allow value acceptance above 80% on purchases. The exception is rural high needs areas, which we'll cover later. So if you hear a friend got a waiver on a 5% down, they were likely in a special category, not the standard one. For the everyday buyer, 20% down or more equals eligible. Under 20% down equals ineligible. Even with 20% down, the prior appraisal rule still applies. When it comes to refinances, the rules for value acceptance split into two groups: limited cash out refinances and full cash out refinances. And each one has its own LTV limits. On a purchase, Fannie Mae caps value acceptance at 80% loan to value. But on a limited cash out refinance, the limit is higher. So you can go up to a 90% loan to value on a primary residence or a second home, and up to 75% on an investment property, as long as the file receives an approved eligible finding. So those higher limits often catch people off guard, but there's a simple reason for it. You already live in the home. The lender already has a performance history on the property, and the risk profile is different than a brand new purchase. Then you have full cash out refinances, which are more restrictive. For those, the limit drops to 70% on a primary residence and 60% on second homes and investment properties. Anything above those numbers automatically require a full appraisal, no exceptions. And that's why refinances tend to get waivers more often than purchases. The LTV boxes are wider in some of the refinance categories, especially for limited cash out scenarios. And that gives DU more room to issue value acceptance when the property and prior appraisal data line up. The list of ineligible transactions is straightforward and absolute. If your loan falls into any of these categories, DU will not issue a value acceptance under any circumstances. 2 to 4 unit properties, co-ops, manufactured homes, proposed construction, construction to permanent loans, home style renovation or home style refresh loans, leasehold properties, community land trust homes or restricted resale properties, Texas 50 A6 cash out loans, properties valued at $1 million or more, so purchase price or value input into DU, loans using a gift of equity, manual underwrites, ineligible DU findings, loans where rental income from the subject property is being used to qualify, and loans where mortgage insurance requires an appraisal. So if you're in any of these categories, no borrower strength or down payment size can override the rule. Most buyers don't know this rule exists. If your loan uses rental income from the subject property to qualify, even if the property is a one-unit home, Fannie Mae requires a full appraisal. Why? Because rental income affects risk, and Fannie Mae needs third-party verification to confirm condition, marketability, rentability, valuation stability, and comparable rentals. This is one of the reasons buyers house hacking or using accessory dwelling units rarely receive waivers. The income shifts the file into the must appraise category. If the seller is giving you a gift of equity, typically in family sales, Fannie Mae requires a full appraisal. Because the sales price does not reflect open market conditions, DU cannot rely on prior appraisals or use automated valuation logic. So these loans always require a full appraisal. Buyers in family transactions often expect the process to be simpler, but this is one of the few areas where the rules tighten instead of loosen. Fannie Mae does allow a special version of value acceptance in certain rural high needs areas. This is a completely separate track with its own rules. To qualify, the loan must be all of the following: purchase transaction, one unit principal residence, borrower income at or below 100% of the area median income, property located in an FHFA identified rural high needs census tract, an approved eligible, a loan to value up to 97%, and a CLTV up to 105% with community seconds. And the property cannot be a manufactured home. This is the only scenario where value acceptance applies above 80% loan to value on a purchase. But there is a catch. The lender must obtain and review a full home inspection. This inspection is not an appraisal. It does not determine value. It verifies property condition only. To use this type of value acceptance, the lender must verify the home is safe, sound, and structurally secure. The inspector meets licensing or accredited standards. The borrower signs an affidavit confirming receipt of the inspection report. Repairs affecting safety, soundness, or structural integrity are completed prior to delivery. For most buyers, this category doesn't apply, but where it does, it can save meaningful money and time. Even if DU issues value acceptance, the lender must override it and order a full appraisal if rental income from the subject property is used to qualify, lender is required by law to obtain a new appraisal, the lender has any reason to believe the appraisal is warranted, the loan is a Texas 50A6, the lender already ordered an appraisal, or if the lender sees anything in the file that calls value, condition, or marketability into question. Value acceptance is a privilege the lender may exercise, not an obligation. If anything seems unclear, inconsistent, or high risk, the lender must order an appraisal. Buyers sometimes misinterpret this as a lender being picky, when in reality, the lender is following federal law, Fannie Mae guidelines, or internal risk rules. DU looks at the prior appraisal if one exists and is usable, that property addresses match, transaction type, LTV and CLTV, the occupancy type, the loan purpose, DU's risk assessment, data quality flags, comparable base scoring, and market condition indicators. If any one of those items fall outside of the eligible range, DU won't offer value acceptance. There's no manual override. There's no form a lender can submit. There's no exception request. This is why your friend's file might have qualified and yours didn't, even with the same down payment and property type. The DU decision is strictly algorithmic. This is something almost no buyer is warned about. Waivers can disappear, and here's why. DU's value acceptance offer is only valid if it's less than 4 months old on the note date. So if you modify the file and some modification changes DU's risk assessment, the waiver can vanish. Common reasons are changing loan terms, changing loan amount, changing interest rate, changing occupancy types, updating income documents, correcting asset amounts, locked rate expiring and needing a new lock, appraisals being ordered accidentally, lenders submitting the file at a different time than when DU logic has been updated. Because DU runs on live logic, reruns can change results. This is why lenders protect a waiver once it's offered and why they're cautious about unnecessary modifications. Appraisal waivers have nothing to do with credit score strength, assets, income, down payment beyond the required loan-to-value limits, borrower profiles, relationships with the lender, how strong the offer is. Two buyers with identical finances can get different outcomes because the properties have different data histories. One has an eligible prior appraisal, one doesn't. One property triggers scoring flags, the other doesn't. One falls into an ineligible category, one lender submitted at a slightly different time. One loan type allows for it, the other doesn't. Most of the logic sits behind the scenes where the consumer can't see it. So comparing yourself to another buyer is one of the quickest ways to get confused about how waivers actually work. There's no trick, but there are factors buyers can control. Number one, choose the right loan type. So value acceptance is only offered on DU approved eligible files, so loans sold to Fannie Mae, certain purchase and refinance categories. So if your lender places you in a program outside of Fannie Mae, you may not be eligible. Number two, stay inside the loan to value limits. So if you want the option of a waiver, your purchase target an 80% loan to value or lower, a limited cash out refinance up to 90%, and on a cash out refinance, 60 to 70% depending on the occupancy. Number three, avoid loan features that automatically disqualify you, such as rental income qualification, gifts of equity, restricted resale properties, 2 to 4 unit homes, construction loans, home style renovation or refresh loans. Number four, avoid requesting an appraisal unless absolutely necessary. So if your agent or another party suggests ordering one just in case, that immediately eliminates the possibility of a value acceptance. And five, provide all documentation early. Clean files reduce the need for reruns that could remove a waiver. Number 6, don't change loan assumptions mid-process unless needed. So small adjustments can force DU to reevaluate the file. Buyers often unintentionally eliminate their own waiver without even realizing it. Here are the big ones. Do not rely on online valuation tools to argue for a waiver. DU does not use these. Do not assume a high down payment guarantees anything. Loan to value limits matter, not the down payment itself. Do not assume your lender can request a waiver. There is no request button. Do not change your loan product or deal structure without asking whether it affects DU, and do not compare your file to someone else's. The differences are usually invisible to the buyer. A waiver does not mean the home is approved, or that the home is worth the number you input, or that Fannie Mae has inspected the property, or that the lender guarantees no issues. It simply means Fannie Mae accepts the value estimate the lender submitted based on the available data. Condition issues can still exist, inspection issues can still exist, structural problems can still exist. Value acceptance waives the appraisal, not the buyer's need to understand the property they're purchasing. For many buyers, this is the real pain point. If DU doesn't offer value acceptance, here's how to think about it. It's not a reflection of your strength as a buyer. It's data availability, not borrower quality. An appraisal is not a setback, it's protection. You get professional verification, a full valuation, comparable analysis, insight into market conditions, and an unbiased assessment of the property. Your closing timeline may be unchanged because most appraisals come in within the standard contract timelines. A full appraisal may give you negotiating advantages if issues arise. Waivers remove the leverage you get if a value discrepancy appears. Refinances still frequently get waivers even when purchases do not. So if you don't receive one today, you may still get one in the future. If you're planning to buy in 2026 and want to understand whether your scenario qualifies for value acceptance, use the link below to book a call with my team. We'll look at your loan type, your down payment, your loan to value, the property you're considering, and whether a waiver is likely or not based on the guidelines. Our goal is simple: give you clarity before you make decisions, not after. And if you want calm, straightforward explanations about home financing that help you move forward with confidence, make sure to hit that subscribe button, and I'll see you on the next one.